No one trusts treasuries any longer, and that's the truth of it. And you can see that. I know it's only been a couple of days, but recently we've seen the 30-year treasury go up and the dollar go down. Now, normally they're supposed to move together. I mean, you would think that the the U.S. dollar, the global reserve currency, the epicenter of trust, right? If interest rates go up, for whatever reason, usually a strong economy, you're going to see interest rates start to go higher, get fear of inflation or whatever it may be. But as interest rates go higher in the dollar, it usually would be more demand for return. And so people would flood into the dollar. The dollar should go up. We're seeing interest rates go up and the dollar go down. That's an ominous sign. Now, 2 days does not make a trend, but if you continue to see the dollar go down and rates go up, that is further proof that the world is tired of holding U.S. treasuries, not only because of the fiscal and monetary hurdles that we have to overcome, which seem insurmountable, maybe are mathematically, but also the lack of trust in our foreign policy and in what happens if you end up on the wrong side. Like, maybe this is why India and Saudi Arabia are straddling, if you will, and very much so. Saudi Arabia, differently than India as a charter member of BRICS, India, but they both seem to straddle both sides of the fence, placating to the West while still being heavily involved in the BRICS. You look at Saudi Arabia, who hasn't made a formal decision yet, is a charter member of Enbridge, which would be one of the catalysts to hurting the dollar more than anything. And so I think that it's becoming very real. It's a matter of how does this all play out? I don't think anybody knows, but I think it's something that is becoming very difficult for the West to do much about. And I guess we'll have to see how many new countries are admitted into the system.
Rising yields alone aren't the real warning sign. Rising yields paired with a falling dollar is. Andy Schectmam's point is that this divergence breaks the usual pattern, where higher treasury returns normally pull capital into dollars. It could signal foreign investors demanding better compensation while quietly trimming their exposure to U.S. debt. For everyday savers, that persistent gap threatens purchasing power even without any dramatic market crash.
The new BRICS platform, but I think everything that they are doing from payment rails to precious metals, where, it is a system that it's an asset that requires no counterparty fulfillment. It's an asset that has value independent of any counterparty, no counterparty risk if it's held in your own possession. And we're seeing that. We're seeing the central banks buy more gold than at any time ever, year over year over year, 1,000 tons plus 3 years in a row. The central bank said that they bought 16 tons the first quarter, and the World Gold Council said you're lying by a factor of 15. Now, you've actually bought 15 times more than you said. Why are you lying? And the same thing, Goldman Sachs said the same thing about China. I think it was 4.5 times understated or whatever the number is. But the central banks are reporting voluntarily, and they're underreporting purposely. And if you watch, you can see the massive purchasing by the central banks that isn't stopping. And here again, massive second quarter purchases by the central bank, huge second quarter purchases by the central banks, if we believe them that the numbers are what they say. But remember, all of this purchasing we've seen this year, Michelle, has happened as the price has gotten clubbed. And so what do they know about where this is ultimately going when they continue to purchase hand over fist at a time when the price has done anything but go up in dollars? Certainly it's gone up in Japanese yen, but they're buying it, and they're buying it at a level that is unlike anything anyone's ever seen, and they're doing it and not being honest about it, as we have found out.
Central banks have been buying gold aggressively, even as its dollar price struggles, and Schectmam argues that contradiction deserves real attention. Purchases have topped 1,000 tons annually for 3 straight years now, and some reported numbers may actually understate the true totals. His question: why keep accumulating during weakness if gold's strategic importance is supposedly fading? To him, that behavior suggests institutions may value insurance over short-term price performance far more than official messaging lets on.
So far this quarter, the second quarter, we've already seen a 407% increase quarter over quarter, or 231 tons. So year to date, they bought 345 tons and that they've claimed. And Poland has bought 82 tons. And that's the same Poland, by the way, where they asked Adam Glapinski, I've said this before, why is Poland buying so much gold? Because we buy gold and the Central Bank of Poland buys gold because when someone pulls the power to the global financial system, one that is dominated by electronic accounting records, we want to be able to be prepared for even the most unlikely circumstances. Now, something to that extent, you have the head of the Polish Central Bank buying more than anyone, including China, for 3 years in a row, and they say they're buying it for other reasons than most would think, because when someone pulls the power on the system. By the way, Adam Glapinski also has gone on record recently and said that these pullbacks that we've seen so far this year has been nothing but an opportunity for Poland to add more gold to their reserves. As we can see it at 82 tons that we know for sure have been purchased this year. So the biggest money in the world is accumulating gold as if they know something. And who's doing it here at home? And that's the thing that, I get some flack sometimes, Michelle. People say, well, it's not leaving. Some leaves COMEX, some doesn't. Is it just the central banks playing or the commercial banks playing games? My answer to that is no, because they never did this before. They never, ever stood for delivery. Less than 1% of contracts did. They would cash settle, they would exit the trade, or they would roll forward. Now they want numbered bars in their account. And my question is, much like Tether buying huge amount of gold so far this year, continuing, in fact, Tether's bought more gold than anyone but Poland for the last 2 years. Who's doing it? And could it be the Exchange Stabilization Fund, the cent who understands gold? Could he be the one saying to the banks, we want to stay at arm's length?
The bigger signal here might not be gold's price at all, but who's actually demanding the metal behind it. Schectmam points to a broader shift away from paper exposure and toward identifiable physical bars, alongside Poland's reported 82-ton accumulation. That matters because physical possession removes any dependence on a counterparty, something that matters a lot if electronic settlement systems ever face disruption. His advice is to watch delivery behavior more closely than daily futures price swings.
I don't want our footprints in the snow, but you're going to buy a ton of gold for us. You're going to put it into the COMEX and leave it in your house account. We'll get it when we want it. We don't have to worry about any shenanigans on the COMEX. We're the U.S. Treasury. And if we pull it all out, well, they'll be able to follow the footsteps. Let's leave it there. And it makes the analysts in this industry say, well, couldn't it just be the banks playing a game? No, it's not, because they do the game with paper and warrants, not with physical delivery. And I think the same thing should be asked about Tether. We can talk about that if you want, but the bottom line is that gold is being rewoven into the monetary system quietly here and far more overtly across the globe.
Right, and I will get into Tether and the potential U.S. connection there. But to your point, we are seeing central banks buying gold at record levels. Interestingly enough, Poland, who's not part of the BRICS, a big proponent of gold purchasing and not even necessarily linked to this alternative railway that's being built. But it's pointing to that broader trend of de-treasurization and accumulation of gold. And, one of the pillars in your thesis here, as this multipolar financial infrastructure gets built, is the architecture, the plumbing. But, you touched on this, and that's the exchanges and price discovery, because another pillar of your thesis, which I find very interesting, is what is the real price of things, price discovery. And I think that is a point that often gets overlooked here, Andy, because a lot of the discussion focuses on payment systems and local currency settlements. But we're also seeing efforts to build entirely new marketplaces here. We've got the BRICS agricultural ministers reaffirming plans for the BRICS grain exchange. Russia is saying that project has now entered its design phase. And officials have also discussed a BRICS precious metals exchange, all while Hong Kong is continuing to expand its yuan-denominated gold pricing and emphasis on physical. So, is the objective here, Andy, to create alternative centers of price discovery? And explain why that is so important, because if you control where commodities are priced and how they're priced, how much influence does that actually give you over the global financial system? Explain that to us.
Why do you think the West has guarded that right and that privilege for so many years? Yeah, of course it does. And if you are hell bent on doing that, the first thing you do is play the game against the West and stand for delivery, quietly, methodically play the long game and just wait everybody out. And they are doing that. We know that China produces more gold than anyone in the world, second most producer of silver. We've highlighted how they fly all around the world buying doré and concentrate, using the Western price, paying twice what the West will, and bringing it back and refining it from Peru and from Mexico. We see the deals they've struck all around the world for, gold mines and infrastructure within the Belt Road, building up the ability to withdraw these natural commodities and take possession of it. If that was your intention, and you stand for delivery in a way that you're being caught at least 2 or 3 times by entities like the IMF or the World Gold Council, or recently by Goldman Sachs, looking at the import-export numbers, recognizing it's a voluntary admission to report it, but having it accumulated by People's Liberation Army and proxy banks, and standing for delivery, playing the Western game. You guys are stupid enough to suppress the price. We'll play your game, and in fact, we'll incentivize you to do it by having a year-long 10 to 15% premium on Western silver. In other words, we'll pay you 10, 12, 15% more to buy your silver. You just ship it to us, and you'll make a gazillion dollars. Same thing with gold, $85, $90, $100 premium on gold. So ship it. Now, arbitrage doesn't last long. Normally, the traders fill that gap quickly.